Let's take a look now to 2026 in the markets. We're joined by Lyle Stein, president of Forvest Global Wealth Management. Lyle, thanks very much indeed for joining us. Great to see you as ever. What are the big themes going to be in 2026, do you think?
Well, it's really interesting, Andy. We went this past week and, normally you have to read all these research reports and all the rest. Well, we just used our wonderful AI tools and we asked, what are the biggest risks to the market in 2026? And the elements that came up were at the top of the list, inflation concerns. Second one was, the geopolitical concerns around the world. And then the usual market valuations and things like that. The interesting thing as we look at 2026 is the layout of trying to forecast markets by forecasting what's going on in the world. And as we look at 2026, it's almost going to be as important to forecast what's going on in markets to see what's happening in the world. And that all fits into that K-shaped economy that people talk to. The notion that those who do well are doing really well, but the bulk of people are on the downward slope of that K. So the economic recovery that is milquetoast is being fed by the high earners, high asset owners, and there's still a lot of pain amongst those who aren't participating, those without assets, those without houses, those who are concerned about their jobs. And so all this is in the mix for 2026.
I suppose the richer people tend to own stocks, and they're feeling rich with markets near record highs.
And that's exactly it. I mean, the AI boom has been very important for the U.S. economy. We know that. It's about half of economic growth in 2025. But the wealth that's been created by the AI boom has been particularly good for those who own stocks. And so that is a big driver. If we lose the momentum in the market of those who own AI stocks, because it does look like they're getting a bit tired. NVIDIA is the poster child there. That could have an impact on consumer spending, which has an impact on the economy. And it could also have an impact on all the ETFs that own the NVIDIAs and the big hyperscalers.
Wow. Do you think we could? Well, we've talked about this for years, that we could see a flight from index funds and then it would turn into a self-fulfilling thing because the index funds, as they get redemptions, would have to dump those big tech stocks.
That could very well be the case. And now the interesting thing is we're just coming to the end of tax loss selling. Nobody sold those stocks this year because you've got a big tax loss. Now, through 2026, will that in fact hit the market? It's a tough thing to call. We won't be able to make a forecast on whether it'll be ETF redemptions, but we could see a slow drip out of them. And that would be consistent with a general multiple decline in the market, which would be exacerbated by fears of economic slowdown.
What do portfolio managers tend to do at this time of year, Lyle? We hear about window dressing. What are the main goals here?
Well, the number one is just to finish the year on a good note is the most important thing. Window dressing, the notion that I wanted my portfolio for December 31st to look like more of the index, more of the things that won. I think that's been somewhat lost with, as you said, the rise of ETF investing. But active managers, don't want to be too far offside if they're managing funds that are on a relative performance basis. At our shop, we're more absolute performance than relative performance. And so we don't mind if we have what we would call in the business bets on certain areas of the market and then bets against other areas of the market. So again, that window dressing applies primarily to index huggers, not active managers looking with a total return bias.
I guess people think there's a safety in numbers, a herd instinct among portfolio managers, and they tend to hold the big funds anyway, very much the same stocks.
Well, and that's a big risk here because you got to be the smarter guy is the one who's going to be ahead of all the rest. And so once the first button pusher goes, everybody else will pile on. That's where it gets really tough. That's why as we look at the world for the next 1 year, 3 years, we have a consensus view. We know what that is, but you have to ask, where is the consensus going to be right or wrong? So it's almost better to look at the analysts that have the lowest estimate on a particular stock and the highest estimate than it is to look at the consensus number and see how that's changing.
What about trade and tariffs? I mean, that's a very broad topic, but we are going to get the renegotiation of the or beginning of a reworking of the North American trade agreement next year. Of course, we'll get lots of pronouncements and heat and noise from the White House. But is that a thing you're paying much attention to? Obviously important for the Canadian economy.
I think it's particularly important for Canada relative to the rest of the world. We're still living with, very high tariffs imposed upon us. And if we lose the NAFTA agreement, we're at risk of seeing even further tariff increases, just given the appetite for Canadian-American relations right now, it isn't necessarily that great. But more importantly, we've got the big decision we think is coming maybe this year, maybe early next year, on what happens with those tariffs at the Supreme Court. We've heard also that companies are holding off increasing prices till they get some clarity, perhaps from the Supreme Court, before they might raise prices in the first half of the next year. And then there's all this discussion about, well, if the tariffs roll off, that'll be more of a second half of next year. So the tariff uncertainty is pretty high. I think you have to, again, look at it in the context of the securities you're owning as opposed to the market ETF that you own.
Yeah, I mean, in fairness to Prime Minister Mark Carney, the tariffs, there's big levies, as you note, on steel, aluminum and lumber, but we've dodged the worst of it because if they're covered by the North American Free Trade Agreement, Trump isn't tariffing them right now.
Well, that's right, and that's the risk that we face if, in fact, the NAFTA, or sorry, the USMCA is torn up. If that's torn up, then we could face some additional pain. But again, I think we'll get clarity out of the Supreme Court, and also the Trump administration is talking about what they're going to do if, in fact, they lose at the Supreme Court.
Right. Yeah. The rules, of course, the system's against Mr. Trump. Everyone's been very unfair to him. Lyle, we'd better leave it there. Lyle Stein, president of Forvest Global Wealth Management. Thank you very much, Lyle.